Yashpal, hi, thanks for joining in. Good to have you on the show. You know, your company reported a strong profit of 58%. However, if I look at your NII, that was just 2.5%. What led to a strong profit but slow NII growth?
See, obviously, good morning. First of all, you are right that on profit front we have done very well. In fact, on year also we have grown 17%. Q4 to Q4 we grew by 58%. The NII of course was under pressure because of heavy competition from other players, especially first part of the year and from the banks. So, lot of customers we had to reduce the rate, but as the second half came in, the competition reduced because of the problem facing other competitors, and plus we were able to pass on the increase in interest rate. So, the NII basically reduced because of the competition from the especially from the banks whose cost of funds are lower, but still we maintain good profitability by maintaining the lower reserve provision for the NPAs by reducing the NPA or maintaining at the same level. The second thing is that of course we have shifted during the year from the Indian GAAP standard to IFRS, the Ind AS which is called. So, that has also had an impact on the provisioning. But I would say overall, considering that what market was facing going through in terms of liquidity position, in terms of the overall NBFC sector facing the problems and transition to Ind AS, plus the last quarter there was some slowness in the market because of the elections. Despite all that, I think 17% growth year on year in the profitability is quite good.
What about margins? Because they also have improved about 10 bips sequentially. What led to the improvement despite the liquidity issues? And if you could give us an outlook on margins and how do you see your borrowing mix change for FY20?
Yeah, so the second half of the year, as I told you, we were able to pass on the interest rate to the customers by increasing the lending rates slightly. So, that is what led to the improvement in margins. In fact, if you look at the new business, the margins are 15 to 20 BPS higher than what is they were there in Q3. So, that led to the increase in the margins, and we are hopeful of maintaining 3% plus margin in the financial year 19-20 also. As far as borrowing mix is concerned, we are quite dependent on the banks, and fortunately, even though the NBFC sector as a whole is facing problems, the banks are quite comfortable with us. During the Q4, we also got 5 crores of sanction from NHB for refinance, of which we do 300 crores. But considering that the bond market is not so good at this point of time, we do not see any change in the borrowing mix. We will, at least for the current year, we will rely on the bank borrowing and NHB refinance.
Okay, fair enough. You know, there have been what's the kind of loan growth you're targeting as well for FY20? As you know, which are some of the regions that you'll be focusing on as well for growth?
Yeah, so the overall growth rate that you are targeting for the current year, that is net book growth, it is about 14 to 15%. And the Tamil Nadu market, as you are aware, has been quite low during last 2 years. In fact, in the last year also, the Tamil Nadu book growth rate was only 6%, whereas rest of India grew by 22%. Rest of India means where we are present in other parts of southern India like Karnataka, Andhra Pradesh, Telangana, and parts of western India like Maharashtra and Gujarat. So, these are the areas we will be targeting. Plus, we have opened in the last quarter of the financial year few branches in Rajasthan and also in Madhya Pradesh. So, we expect to grow in those areas also. But Tamil Nadu continues to be our biggest market and because they have 56% share. So, their growth rate is expected to remain muted. Overall, we are targeting 14 to 15% growth rate.
Sure. Some concerns on the real estate sector as well. Are you seeing, you know, rising risks of NPAs, especially in your LAP book when it comes to FY20?
Yeah, there are risks in the real estate sector, but we expect that with the new government coming in and RBI reducing the rate of interest, the banks have so far not transmitted the cut. This cut should be transmitted. We hope that it will happen. On the real estate sector also, we expect Government of India to move ahead with full reforms. But yes, real estate sector is facing challenges. As far as the NPAs on the lab book is concerned, because as per our business model, we do not finance SMEs or the companies. Our borrowers are individuals. They may be owners of SMEs companies, they may be owners of private limited companies, but they borrow in their individual capacity. So, we do not see there will be a surge in the NPA. In fact, we expect in the current year NPA levels should go down actually.
What kind of disbursement trends are you seeing in the Tamil Nadu market, and what really is the outlook going forward of the kind of growth that you foresee in the state?
Yeah, as I told you, Tamil Nadu continues to remain muted, even though even now it constitutes the single largest percentage of our company, but as a percentage of the base, the growth rate is very low at about 6%. This year also we are not expecting more than 10% growth rate because of the other problems. As I told you, they have not overcome, but we expect to grow higher in other parts of South India and Western India. Tamil Nadu remains a challenge for us.
So let's talk about you talked about the lap book and so forth, but the GNPA ratio, let's talk about that as well, and what's the outlook going forward also on the home loan book side?
Yeah, so on the lab book, the GNPA is about 5%. The housing loan book is about 1.8%. So, overall is 2.95% as on March, and going forward we expect to maintain or actually reduce. In fact, we have given the guidance of about 2% for the next financial year by the end of the March 2020. But what I want to clarify to you is that unlike the banks, our NPAs are, because they are individual customers, even after becoming NPA, more than 60% of the NPA accounts continues to pay one installment or two installment intermittently. Of course, because NPA definition is a watertight compartment of 90 days, so they are not able to come down to below 90 days to be classified as standard, but still they continue to pay. In fact, in the last financial year, 60% of our NPAs paid some installments. So, while NPA is a concern, but unfortunately for us, it is not having that big impact on our P&L as it should have, because if you see, our ROE still is close to 18%, our ROA is about 2.2% for the entire year, which are one of the highest in the industry. So, while NPS is an area of concern, but in terms of profitability, they are not affecting much. And on the liquidity front also, while so many NBFCs and HFCs are facing problems, we have no problem. We have met all our repayments on time. In fact, even as on March, we have 1,100 crores of undisbursed sanctions, and we have about 3,000 crores of fresh sanctions lined up in next few quarters. So, I would say on those fronts, we are doing reasonably well.
Okay, a few questions on the RBI. You know, they've come out with liquidity related norms for NBFCs as well. You know, and generally the NHB tends to issue a separate notification. Do you see any impact of this?
Yeah, so one is that yesterday NHB has already issued a notification for all the NBFCs or HFCs rather to appoint a chief risk officer that we will appoint shortly. The second part, as far as liquidity coverage ratio is concerned, so far NHB has not issued any circular to best of my knowledge at least. But if it is issued, I have seen the RBI circular. I definitely feel that the NBFCs and HFCs have to maintain liquidity coverage ratio. But when I go through the details, there are some aspects which I find are probably not relevant to NBFCs and HFCs. They have to that extent sort of gone along with what they are doing for banks. I will tell you for that example, they have put a dynamic ratio that you have to monitor on daily basis. I do not think, unlike banks who have large CASA deposits and working capital lending, where the asset liability mismatch changes on daily basis, for NBFCs and HFCs it does not change on daily basis. So, daily monitoring will be probably a tedious task. The second thing they have said is that you have to invest in either government securities or keep cash. If you invest in even bank deposits, there will be haircut of 20%. Now, for NBFC and HFCs, we keep money with the banks only. So, while I agree that theoretically banks do not have a sovereign risk, they have a higher risk than sovereign risk, but probably there RBI can give some relaxation. The third part is that in our business model particularly, there is a contractual maturity and there is actual maturity. Like for example, in our company, last year our normal repayments were only 700 crores of loans, but prepayments were close to 1000 crores. Now, in the calculation of liquidity coverage ratio, should we take the actual repayments or should we take the behavioral repayments? I think we need to have clarity on this. But overall, I still feel for our company impact will not be much, because we have done some back of the envelope calculation that we need to maintain about 250 crores on an average basis throughout the year. Now, 250 crores, even if we lose about 3 to 4%, works out to only 10 crores per annum, which if we take after tax will be 7 crores of loss to reduced profit to us, which is only 0.5% of the equity base. So, impact will not be large in terms of financial numbers, but yes, in terms of the putting in place systems and procedures in place of somebody having to monitor it on daily basis, setting up a full-fledged treasury department, those costs will be high, and we hope that NHB, when they come out with these guidelines, they will keep this into account. But as far as the impact is concerned, we are fully prepared.
All right. Thank you so much for joining us today, and taking us through all those key changes and outlook as well going forward, Mr. Gupta. Good talking to you.